I say welcome and good morning. And first I want to say thank you to Linda and to Carlos for being so kind as to invite me here. And I certainly hope that I can provide some information, some helpful information to you all. And I know that I also want to say that I want to commend Mark and Trace for the excellent presentations that they've conducted so far. I think that they just do an excellent job. They're very they're outstanding in their field and their discipline. And as traders, and I'm just really feel honored to be a part of it all. And those of you who are with Trace or Mark, I think you're in really good hands. And congratulations for that. I do want to also say that you may find my methods somewhat simplistic or somewhat basic, and I know that a lot of people will come to workshops looking for a magical formula, a new twist on things, a different outlook, and different ways of applying methods, strategies, and so forth. But you'll also find that I do integrate the fundamental aspects of the global financial markets, global economies into my trading protocol. However, my decisions are made typically based on a technical foundation. That's not to say that I won't also trade based primarily on fundamentals, because once you understand the fundamental drivers of the FX market, then you're able to help to discern some of the technical aspects better and be able to refine your trading decisions and be able to manage your trades accordingly under the backdrop of the fundamentals. And I know that there are just thousands upon thousands of different ways to trade. Of course, every individual that there is in the financial market, they have their own way of trading. I believe that is absolutely critical, that in order for you to really excel in trading, that you must become an independent thinker. With whatever strategy it is that you employ, or whatever resources that you rely on, it is still going to require, ultimately going to require independent thinking, because if someone shares with you a certain aspect or a technical aspect or some aspect as to why they're entering into a trade at any given moment, they have within their own mindset, based on the information that they withhold and their understanding of the market, they have their own parameters for making the decision why and when to enter and how they're going to manage the trade from that point forward. And that is absolutely not duplicatable. And at some point you are going to be left having to become an independent thinker and have not to lean on anyone while engaged in any trading situation. So I think that independent thinking, for me, it was the aspect of becoming an independent thinker when the equity curve started to move. Yesterday Mark drew on sort of how some of the shifts in his trading occurred. For me, the real shift came when I became an independent thinker, because I started to realize that I had maybe some gifts or some advantages in certain ways that allowed me to separate myself from people who I held as authorities, but they have their own their expertise. If I do if there's one component of my trading that probably stands out in my opinion, it is certainly not the technological aspect or the over-analytical aspect. It would be more on the psychological aspect. That is probably my strongest contributor to the results in my trading and the growth in my trading. And the more you get to know me, the more we can help to maybe share and understand some of those things. But I believe that those are some of the strongest contributors. What I'll do is I'll just give you maybe a little bit of my background as well. Actually, before I move forward, I wanted to say about the hundreds of approaches to trading, and people will come to a workshop wanting that magic formula or wanting just that quirky little thing that's going to up their percentage win-loss ratio by just a few percent and so forth. Or maybe find a technique that jives with their personality, because I think a lot of trading is about finding a strategy and an approach to the market that is in connection with your personal human quality. I have one of my best friends is a commodities broker. He has a client, and This client does about 80% of his volume as a broker. He's been in the business, the broker's been in the business 20 years. His client trades the gold contracts, and he trades, his contract sizes are range in the equity. The daily equity swings are in the 1 to 2 million range on like kind of like can be on like a daily or weekly basis. The equity can swing up by $1 million, down by $1 million, 2 million. He's very, very successful, trades mainly gold, and he's independently wealthy, supports a lot of charitable causes, and he's also blind. Okay, doesn't look at charts. Okay. So that's why I say that I think that your understanding and your intimacy with the market, we're trying to take market and price action with our personality, and we're trying to mesh the two. And only you can find that. You know, ideas and so forth can help you along the way, but only you can ultimately find that. I've got a fellow who I trained. He's in Australia, and he is now managing some funds. Very successful trader, trades a lot on my concept, but has designed it to his own, but more or less scalps off the bank. And he has no education. He came from Romania, and he had to go into the development and building business, and then he did okay in that. Made a lot of money, lost a lot of money, but then moved to trading, no education, and he's now, but when he interacts with the computer, very sharp. And I've got a number of other stories that I can share with you, and I will sort of interject them because some are clients and so forth and people I work closely with. And just because what I want to do is I want to give to you sort of their view or how we interact. Because one of the things that we want to accomplish here is to broaden your mind on how to view the financial markets as it relates to you personally. Okay. Now, how many of you are currently trading, currently trade FX? And do you trade it quite actively or part-time? Okay. Because some of you are not. So there's a couple things that I want to accomplish. Is number one, because of the technical aspects of my methods if you're with Fibonacci Trader and been following some of Mark's stuff, you're probably quite familiar with some of the technical aspects. So I want to cover sort of a broader spectrum. Number one, when I talk about some of the fundamentals and some of the type of position considerations you can make on a longer term perspective, it may help you for your asset management, your portfolio management and diversification, help you to get into the longer term position trades, because I believe that if you've got $50 or $100 or a house and the equity in the house is in one currency, you have currency exposure. And I think it's prudent to balance that, and many of you know as a result of the recent US dollar movements that it is that your exposure has obviously been changing and been quite volatile the last little while. So, and then I'm also going to kind of grind down, if you're interested in intraday trading, then we're going to look at those aspects of exactly how we're finding our trades for intraday trading. Because I do all of them. I do intraday trading, short to medium term trading, and I also take long term positions as well with clients. We take other types of more exotic strategies, which I can share with you as well. A little bit of my background. I'll try and go through this quickly because we got a lot to cover, and we're really going to motor. I grew up in a family of 8 kids, same parents, and we were all very close together in age. And as I grew up, we were like kind of a self-sustaining household, and we did not get paid for any work around the house. We did not receive an allowance of any kind. And but as we grew up, my dad taught us how to understand money and the value of money from the time that we were real little, like 6, 7 years old, with checking accounts, understanding savings. We had to save a certain amount, but the money that we acquired was not done so through the household. I don't remember my parents ever handing me not even $1, not even 25 cents for some special treat of my own. Not even once, which I love that, and I'm so appreciative that they were like that, and that worked for me. It worked with my personality. And so, for example, if I wanted to buy a bike or some asset, then I was taught to finance it. So depending on how old I was, I would have to They would maybe pay a little bit of it, but I would have to finance the rest. And they would teach me that, and they'd say, okay, well, where are you going to get the money to pay for this thing? Well, so then my dad would share ideas as to, pertaining to entrepreneurship, and going down the street and asking the neighbors what work they need done around the house, things like that, And I was very appreciative of that, and understood the value of money and the utility of money, and from there forward. And then I was always very heavily involved in sport. Sport was my primary interest. Academically, I would consider myself to be below my peers academically, and sport really kind of ran, kind of more or less directed the course of my life. Competed internationally in track and field, and then I merged it with bobsledding, and then I was aimed to be at my first Olympic Games in bobsledding in 1988. And then in 1988, after my first Olympic Games, then I thought, well, maybe it's now the time to move into the investment business, because all the while I had been trading stocks and so forth. Daily I would check the quotes in the newspaper and so forth, and very, very interested and engaged in some stock trading. At that time I was literally trading in mutual funds when I was in my teens. And then I wrote the securities course right after the '88 Olympic Games, and then I decided, well, I'll continue with bobsledding for a few more years. 2 years later, we became overall World Cup champions, and which we really progressed up the scale very quickly. And I can't even begin to tell you how much work the sport of bobsledding is, with the equipment aspect, all of the physical, the team building, having to find our own sponsors, because we're not provided for. We're not a professional organization. We have to develop our own unique equipment designs and so forth, which we did, and as well as build the team, find the sponsorship, and of course our physical training, which is most important. But for me, probably when people ask me what I miss the most about sport, it's the psychological aspect. Without question, it is the situation where you are tested to the max on a psychological level. I love that. I thrived on that. I was able to just see everything in my environment when tested psychologically, and I miss that the most. And that's what I love about trading, is being in these situations where you're psychologically challenged, where people around you can be breaking down, but you see it differently. So then I went to 3 more Olympic Games after that, and went to 4 in total. And because we started to have success, and success compounded success, and then kind of got on the whole celebrity circuit up in Canada and all that, and so there was a lot of goings on around that. But when I left my career, it was very, very disappointing, because I built a team from nothing to becoming one of the best in the world consistently, and then it was very, very, very disappointing, the experience that I had with the organization. Right at the last minute at my last Olympic Games, and it really caused a lot of drama in my personal life and so forth. I really felt hung out to dry. So then that for me, I was literally alone in a place where everything had been taken away from me after I had retired from sport, and I had nothing, and I just sat there and I'm like, okay, now what am I going to do? And I was just so exhausted from everything. I was just completely fried. And I just said, no, I'm going to sit in my basement apartment, and I'm going to focus on something. And because there's a winner that lives inside me that you can't keep down. And so I was in a city, I didn't know anyone, no friends, and I secluded myself from a lot of my other friends and family and so forth, and just started to get down to business. And then, I took a keen interest in foreign exchange. I had, until yesterday, I had never really attended a seminar. I had gotten some CDs, but I went to Google University of Economics. I did go to university, but I've never taken a mathematics class or an economics class in university. However, through the years of watching the financial industry, it grows on you, right? So then I started to trade, and it was a very interesting experience. And you learn quickly about leverage, and so then when I started to trade, I was very, very comfortable with it, and I very quickly was able to make the adaptation on the psychological perspective from sport into trading. They were very similar, and I found trading. I just found it. I just was able to get it. And then, so I started learning some of the technical aspects and what approaches sort of I wanted to formulate my trading. It took about a year. And then when I opened my first live account, I drew down from $20,000 down to $13,000. Then I took a step back. And then a year and a bit in, I started to become very, very confident in my ability to see things and handle situations in the market. And then people started to ask if I would manage money, and I refused because I really didn't think that I was ready yet. I knew that I needed more foundation from an overall fund manager perspective, and I started looking into, you know, requirements for fund managers in terms of understanding the internals of the industry and the equity protocols and so forth, equity management protocols, fund managements, and all the various structures, fund management structures you can put together and so forth. And then I met up with a partner. Actually, it was about 8 months into my trading, and I forgot to mention, this is actually the most important part of it all, was I had met a partner who had started at or about the same time, and I saw this person turn $35,000 into $1 million in his first year of trading. FX, brilliant man, and kind of Trace, you remind me a lot of him. And just he was a very, very brilliant man, saw the market in a certain way, and he really mentored me. And he really started to help my growth curve. Yet at the same time, I was still able to be an independent thinker and grow as an independent thinker. Just the information sharing with this one individual, and that's all I wanted. I didn't want any other information from anybody else, just sharing with him. And he was managing funds. He quickly moved to managing funds at a bank, and then we started to co-manage funds together. We managed 2 funds together. And I'm just so indebted to this individual for the contributions that he made to my growth as a trader. And then he ended up, after some time, this guy was up 20 hours a day staring at the computers, and he was just unbelievable. And then he ended up starting to suffer from some ailments with his eyes from staring at the computer all day long. And he had 3 minor eye surgeries, and finally just said that's it. I mean, you know, he didn't need trading anymore, and he was getting, you know, health-wise, he's not that old, but health-wise he started to deteriorate because of the intensity at which that he worked. He was solely a day trader, and he was more momentum-oriented, where I was more range-oriented. But now he's been creating range systems. He still dabbles and still creates some systems, but now he's gone to the range side after it's taken me 5 years to convince him, 7 years to convince him. But very, very ingenious man. So I managed funds for a while. So now I've stepped back from that quite a bit, and I do have a couple of clients that I trade for, and we do everything from spot trading to medium-term trading to exotic forwards and options positions, so forth, depending upon their personal situation, because there are some unique circumstances. And I believe that FX should be a part of everyone's portfolio in some capacity. And the more you can understand it, the more you can take in opportunities of the FX market. So once again, my technical aspects are going to be fairly straightforward, I think. And what I've done is I've taken a normal manual of mine and I've actually shaved it down to about a third or less and stuffed it in the book here. So we're probably going to move on fairly quickly, but what we can do is, like Mark did, is we'll be able to pack certain concepts in today, but then just expand and take our time and work through them over the period of Monday, Tuesday, and Wednesday as well. And I'm here, just like Mark said, I'm here and very available to you for as long as, you know, as whatever you need, because that's why we're here. And okay, I forgot to mention the workshop part. About 2 years ago, the workshop aspect has been very liberating for me, because it's got me out of the house and got me around and visit a lot of my family, nieces and nephews, and it's really been quite marvelous. I'm very, very appreciative to have the opportunity to share, whatever knowledge I have that I hope can be helpful to you. But it's been very, very nice. I'm a little tired now. My eyes are sore, so I don't know. I may slow down a little bit later this year, maybe next year, but we'll see how it goes. Okay. So what we're going to do is we're going to start out with, in my opinion, and I read something on the internet that Alexander Elder said, and he said one of the key factors in being successful in trading is understanding the market that you're trading. And I absolutely believe in that to the core. And I know that some people, may not necessarily believe that. I believe that to the core. I believe that the more I understand the FX market and the goings-on and the internals of the FX market, the more opportunities that I have. Okay? When you're done with my stuff, you're not going to necessarily leave with one specific method to go home and attempt. We want you to leave with a broad spectrum, with a multitude of viewpoints of the market, and to pick up on opportunities as they present themselves. So what I'm going to do before I start, actually, is I'm going to show you my intraday trading method, and then we'll start. Then we'll step back. Okay? So my intraday trading method would be basically this. Let's say that this is a 60-minute chart. We've got Tuesday, Wednesday, Thursday. The market. This is 0-100 hours GMT. Right here, moving into the new day, as we showed you the other day on the charts. This is 0-100 hours GMT. Price on currency pairs will move, and they'll create a high for the day, a low for the day, and often consolidate into the next day. This is called the range, or the average true range for the currency. This wouldn't be specifically the average. You take the average over several days. Then what I would do is I would have my Fibonacci levels lined up, support resistance levels lined up, and I look for areas where the market can bounce. I'm not necessarily looking to pick the top of the range or pick the bottom of the range. What I'm looking for is areas at which, based on my understanding of the market, where the market will make moves and shifts. Okay? And that's basically it, so we can all go home. But what we'll do is,
it's a 60-minute chart.
This would be a 60-minute chart, but I obviously look at all of my trade only off daily charts, and then I use the smaller charts for making the entry. But we're going to be looking a lot at range and what we call key levels. Fibonacci, I use the word convergences. You can use the word clusters, confluence. I use convergence. I mean, you got to have your own name, right? But there's only a few to choose from. But a convergence of Fibonacci levels on previous swings, extension and retracement convergences, and so forth. Okay, and I apply Fibonacci a little bit differently than the way Mark does, but I love the way Mark does use his Fibonacci as well, though. And I'm actually going to change a little bit now that I've seen what Mark does. But I'll look at considering some changes. But that's basically it. So I'm looking, because for example, if you have euro US dollar and it's only moving in an average true range of 60 pips on a daily basis from the high to the low, you've only got 60 pips to work with to make, say 20 pips. If you're trading off a 2-pip spread, and you're trading off a 2-pip spread and you're looking for 20 pips that day, your commission's 10%. Okay? Some people don't do the numbers on that. So we're going to look at a lot of different ways to find entries in the market, and we're going to look at a lot of reversal patterns that are specific to the foreign exchange market. Okay? That's about as good as my artwork gets, and so you should see my writing. All right. Okay, the first thing we're going to do is we're going to do an overview of the foreign exchange market, just so you can understand sort of the broader spectrum. And I want you to understand one of the things that I was always interested in was I was always interested in talking to other traders to understand how they think, how they process information, where their skill level is. With some people it may be highly technical, like rocket science type, like Trace. And other people it might be more commonsensical. I have a client who is probably the best trader that I know. That has come through one of my workshops and so forth. And this client trades millions, and they're female, and their trade entries are not highly technical. It's common sense. Very, very successful, sharp trader. So let's just cover some of the background. Some of these slides may seem really, really obvious to you, but this slide here is just the market times in relation to where you are in the world. So it's just a chart that you can have available to you. Typically, As you know, the foreign exchange market, if you're on East Coast time, I'm on West Coast time, so I'll start working the European session around 10:30 p.m. and I'll go till around 2 to 3 a.m. Then I'll sleep, and then I like to catch. I don't like the times during the data events releases. I like to catch post-data release activity, so then I'll wake up for typically the close of the European session and then trade through the rest of New York session, or look for trades through the rest of New York session, and then into Asia, especially right now because the Asian market is good lately. The reason why I put these order types in here is I know that you all know all this, is that the reason why is because a lot of the workshops that I will conduct, they are typically with FX traders, and FX traders who have maybe jumped into live trading too soon. And what they will do is I just tell them to cut this out, put it beside your desk, because what they often will do is it amazes me how people are trading live and they don't even know how to properly place an order. Amazes me. And then what they do is they somehow leave an order in their software for whatever reason. The order gets taken in unbeknownst to them. Then they open their software the next time. They say, hey, what's that order doing in there? Then they blame it on the broker. Okay? The broker threw an order into my account just out of the blue. Okay? It amazes me. So I just say, look, when you're placing your orders, or when you're looking to place an order, just have this in front of you. Okay? Every trade is a portrait of the trader who managed it. Whether it's a win or a loss, how you manage that trade is a portrait of how you are as a trader. Okay? So the Bank for International Settlement Survey, we'll just quickly run through this. There's roughly 55 central banks and monetary authorities. Number changes once in a while. And they measure the turnover in foreign exchange markets. Now there's really only about 10 to 15 major central banks that contribute to the vast majority of the volume in the foreign exchange markets. Now the various types of transactions, there are spot transactions, outright forwards, swaps, and OTC interest rate derivatives. And swaps can get very complicated and be very specialized, but there's swaps, enormous amount of volume in swaps and forwards as well. Spot transactions 33%, but these are the various instruments in general categorical terms that are traded in the foreign exchange market. It's important to know this if you're watching the fundamentals and watching what's going on in the banks and the bank feeds, because you'll see, and I'll remember, like if there's specific company takeovers, they may be looking to make the exchange on specific dates, and we'll see maybe major transactions, spot transactions flowing through the market. And if you know that, you'll see price being propped or held at certain levels. The majority of the volume is done by the hedge funds and the insurance companies. Hedge funds, which we'll get into when we get into carry trades and so forth. Just to summarize, this is the 2004 BIS survey. There's another one this year, and the results will come out around September or October maybe, later in the year. So there's every 3 years you have this survey. So average FX daily turnover is 1.88 trillion, probably a lot higher than that now. 57% increase since 2001 already. So it's, and I can see that increase is very interesting, because based on that increase, volatility on euro has dropped a lot. 50% are forwards and swaps, so you can see where it's coming from. 33% are spot transactions, less than 10% are delivered. Right? US dollars involved in 89% of trades, which is almost $1.7 trillion, which means liquidity. Yeah? Euro USD being the highest, dollar yen being next, and then of course pound and Aussie. We see Aussie dollar leading the smaller currencies. 2004, the Aussie dollar. Why would the Aussie dollar be higher than some of the other currencies in 2004? Why would Aussie dollar be one of the? I mean, the volume drops off quite a bit between pound dollar and Aussie dollar, obviously, but why would Aussie dollar be one of the leaders of the smaller?
Some shift in commodities, I would think, maybe. Yeah.
Mm-hmm. Okay, so a lot of it was largely metals based, commodity. Australia and Canada are considered to be commodity currencies. So the economy is largely driven by the commodity aspect of the region. So we see direct correlations between Aussie dollar, Canadian dollar, and, for example, the CRB. Okay? Strong relationship.
Gold and oil.
Gold and oil and Canada, and we'll talk about that. Okay? Those aspects can be no-brainer FX positions for your portfolio sometimes. No-brainer meaning low risk. Okay? How many of you are familiar with the carry trade? So only a few. This is a very, very important trade that we want to cover in some detail, if you don't mind. It's a very fascinating trade, and what it is the carry trade is when, what are interest rates in Japan? What's the overnight rate in Japan? Overnight rate in Japan right now is 0.5. 0.5. Overnight rate in the US? 525. And so the overnight rate right now in New Zealand is 8.0. Overnight rate in Australia is 6.25. Okay? Overnight rate in UK above 5. So we're in what's called, largely over time, probably the major contributing factor to FX moves is interest rates. So as you know, the nice thing is a lot of you are experienced traders, and as you know, market sentiment with any specific instrument shifts. And as I mentioned the other day, the market can have ADD. Sentiment can be largely weighted towards one specific factor, whether it's warranted or not, and then the market sentiment can shift to some other factor. But largely in the FX markets are heavily influenced by interest rate differentials. Okay? So if in Japan we have the overnight rate is 0.5, and if in New Zealand the overnight rate is 8.0, do you think there's a large interest rate differential? Indeed there is. So what traders will do, hedge funds and so forth, and large like private banking clients, what they will do is this, is they will borrow yen. So they'll go to the bank and they'll borrow on margin. So they'll borrow yen, they'll take the yen, which they're paying maybe 1% to borrow the yen. They'll go over to this institution and they'll say, okay, I want to place this yen into fixed income in New Zealand dollars. And that the fixed income may pay, let's say it pays 8%, differential of 7%. Okay? So they're basically making 7% annual for free on borrowed money, on leveraged money, 7% for free. But what's their risk?
Interest rates.
Okay, shift in interest rates is a risk, which can cause the exchange rate to do what? So if there's potential shift in interest rates, then what we'll see is if you have a New Zealand dollar JPY cross, and you're starting to see a selling of yen and a buying of New Zealand dollars, you're going to see this trend go up. The New Zealand dollar JPY cross go up. New Zealand dollar, the first currency is what's called the base currency. Okay? And the direction of the trend is reflective of the strength of the base currency. Okay? So New Zealand dollar will rally against the yen because traders are selling yen and buying New Zealand dollars. Now your risk is that if there's any perceived change in interest rate in the future, you could see this fall. But your risk is basically a devaluation, for whatever reason, of the New Zealand dollar against the yen. So it's the valuation of the pair could fall considerably, and it could affect, of course, the bottom line of your position. You've got a 7% cushion. You've got basically a 12-month 7% cushion, let's say, on the pair. So you can afford some fluctuation of the currency pair. You follow me? Yeah? Let's look at some charts to see what that looks like. Larry?
Do the values collapse? Could they have Could they collapse overnight, or do they collapse gradually?
That's a good question. It's called an unwind, and what we'll do is we'll have a look at that on some charts. Okay? I think this is a very good trade that one can consider depending on your financial disposition. So it's explained here. When I go through when I have dialogue written on the chart, it is things that I'm explaining anyway, so I'm not going to read through the dialogue. Okay? So here's an example. Now, I'll just give you an example of what's been happening. We've been in the FX market, the sentiment is strongly geared towards the high-yielding currencies. So the high-yielding currencies are doing well right now. This is the pound yen. It's a weekly chart. So, for example, from July 05 to February 07, we've moved 4,500 pips, which is a very, very large move, right? Or 45 cents basically. And we've moved from 200 to from 200 to 240. Now you see this move right here. We're going to see this consistently on some of the other charts. We're actually now at 250 now, by the way. We'll look at some charts later, but this has moved all the way up to 250. Some of these charts are a little bit old, if you don't mind. But here's what happened. Let me just walk through a scenario. We have this trend is strong. Okay, not a lot of pullbacks in that trend. It's a weekly chart. Keep in mind, there is very little interest in buying yen against the British pound. So here, traders are borrowing yen, taking the yen, selling them. So the yen's going to do what when you sell it? It's going to fall. It's going to devalue because traders are going in there selling yen, and the high yielders are going to rally. So here the pound is rallying against the yen, and it is rallying very, very steadily. That's a trend that is your friend. That's a no-brain situation. It's moving up because of these fundamental factors, and if the fundamentals are strong, it's a question of where you get in. Okay? Now look at this. Look at this correction here. You see this correction? Do you remember the day of the Shanghai Stock Exchange had a major correction back in February? Do you remember that day? Then it moved over into Europe, then into the US, and there was a major, like a significant shakeout on that specific day. And it compounded into the financial markets around the world. Do you remember that? Yeah? So here's what happens. It works like this. Fund manager, because now hedge funds are more global perspective, because people are interested in global funds because they like the diversification to global companies, and also that's a way of indirectly diversifying foreign exchange exposure. Now, a fund manager, like a global hedge fund will have assets or have investments in various regions of the world. Okay? What they will do is they will take their assets, they'll leverage their assets, and then they'll borrow yen. They take the yen, then they'll go and they'll buy British pounds, they'll buy New Zealand dollars, they'll buy Australian dollars, and they'll invest in those regions of the world. Okay? They'll invest in equities and derivatives, believe it or not. So they're putting at risk the borrowed funds, maybe at somewhat higher risk. Or of course, we would think that they would calculate all of this into the overall formula of the equity profile of the fund. However, they don't do it to the degree that we'd like to see them do, as we've seen Bear Stearns last week, and so forth. Okay? Now, what happens is this. The equities fall in Shanghai by 10%. Okay? Now, they're starting to see, because they bought, a profile of stocks. They see that profile of stocks fall by 10%. Now, in order for them to sell those stocks and repatriate the funds back into yen, now they're losing money. Okay? So it creates a panic in the carry trade. Therefore, you're seeing buyback of yen, selling of pounds out of panic from the fall. Because once they saw it in Shanghai, the fund's already getting squeezed. Then it moves into the next market, gets squeezed even more. So now they're panicking. They're like, we have to cover. And they start to sell out of some of their positions. Then they have to repatriate the funds back into yen. So they have to do what to the yen? They take the pounds and they still have to buy back the yen. So the yen rallies. and the pound falls. Okay, so then we see it affected in the carry positions across the board. Does that make sense? Okay, how the markets are related like this. So I sat on my computer watching Shanghai fall, and I'm like, here we go, because I'm watching the yen start to crash at the same time, exactly the same time. Sorry, the yen rally, but the carry trades make a correction. So then here's what happens. This is exactly what happened. I was not leaving my computer because this is volatility. Volatility is good. We like volatility as traders. We like shakeouts because the higher this thing goes, the more nervous you get. All right, the more parabolic it goes, the more you want to be careful of your position, or you want to protect it and so forth. So I'm like, this is beautiful because a nice shakeout makes me feel comfortable. I'm more comfortable when the market's moving against me than I am. I don't like to chase the market at all. I can't chase it. In fact, it's kind of a bit to a fault. Price comes down. And I literally have recorded I sent out videos to this group, and I literally have it recorded. When price came right down here, I said, you need to get back in the carry trade because the fundamentals are way too strong. Fundamentals are way too strong that it's going to cause it to drain much further. So what am I going to watch to see that this trade stabilizes? I'm going to watch the equities markets, right? See if the equities markets are, okay, give them time, digest the event. Let's wait to see what happens. Okay, it falls a couple more days, no problem. Volatility is starting to tighten up a little bit. Liquidity is coming back in. We're starting to see some support. Okay, boom, get in the carry trade because it is way too, the strength of the fundamentals and the interest rate differentials are way too wide for the markets to ignore it. Okay, so this is the kind of thing. Now what we'll do is we'll see it consistently across on other pairs as well. So, oops. So this is the euro yen. We see the same rally in the same time period. This is the Aussie yen, moving from again the same, from 75 to 95. I've got a client who trades this exclusively. Here's the New Zealand yen. And this pullback here was Colin jawboning his currency. And we'll talk about that a little bit. You know what I'm talking about? Jawbone. Okay, so when Colin speaks, people listen. So it's kind of a form of what the central banks will do is he's in New Zealand, Prime Minister of New Zealand. So what they do is the central banks, there's several ways that they can manipulate the movement of their currency. One way is that, for example, when the FOMC comes out with a statement, we know that there are wordsmiths that understand how the psychology of the market works, and they have to be extremely careful as to how they word that statement, because they understand that the market will interpret it based on the verbiage used, and the markets will respond accordingly. So what they do is they can alter movements in the markets based on the specific wording that is used in statements, in public statements, be it a scheduled FOMC or some other statement, or they can just go in and basically say, we don't care if you sell our currency. So it just gives open season on your currency. And they'll do things like that if they want to see an adjustment or correction. So they call it jawboning, the currency. So then you see movements as a result. Here's dollar yen, which has been more stable. But why would the dollar yen be more stable than some of these other currencies?
Well, this whole time the dollar's been depreciating. So.
Yes. So the general viewpoint on the U.S. economy has not been excessively strong, and then also the interest rates the differential has not been as strong. Okay, so it's a little more stable. Okay? But again, the market goes through these phases of sentiment. Back in like 02, 03, you'd go to an economics conference with a room full of PhDs, and every one of them would be of the opinion and then 04, every one of them was of the opinion that the US dollar was falling to oblivion in 04, okay? Well, what they didn't see was that in the fall of 04, in fact in December of 04, that the bond markets were pricing in interest rate hikes for 05 already. The government bonds, in fact, around the world were pricing in interest rate hikes. So literally January 1, 05, the market said, the year of interest rate hikes, US dollar rallied the whole year. Completely in contra view to a room full of PhD economists. Okay? Which is great because it gives guys like us a chance, huh? There may be some of you in here who are PhDs, I'm sure. So, the banks. Now what I want to do is I want to give you a little bit of a background as to how the, actually before I go there, what I'll do is let me just pull up some current carry trade. Let me just retile this. So New Zealand yen, for example. Here's New Zealand yen's current state, and it continues to move up as of, like, this is literally, today. We saw a pullback in the, we saw a yen rally, this little blip here, but that's an uptrend. This is very, very little interest in getting out of that carry trade. And this is a powerful uptrend that's well supported. Now the question becomes, okay, when is there going to be what we call an unwind in the carry trade? Because an unwind could have global impact if the market just decides to start buying back in. Yes, Jeff?
Well, so in this case, or even GBPJPY, any of the costs other than, let's say, the dollar, in order for that uptrend to continue as it did, there had to be a perception that the base currency was going to continue to go up in interest rates?
Yes. Okay. That's a good point. So for example, what the market will do is the FX markets, as do all financial markets, is they watch closely the potential for interest rate hikes in that region. So for example, when CPI data comes out or GDP data comes out, that can indicate what? Strength in the economy. So if there is a strong number that maybe exceeds expectations or meets expectations, and the market, because as you know, in the financial markets, the markets will price in now what they anticipate for the future. So if the verbiage released by the FOMC suggests that we are likely to continue tightening, or if the GDP data is strong, or CPI, or even the PMI is strong, and others, if it's strong, then it suggests, you know what, economy is good, inflation, continuing to experience inflation, growth. So the bond markets, and you'll start to see the markets will start to price in now interest rate hikes that they anticipate for the specified dates in the future. Okay, so they'll say, so for example, they'll say, okay, the FX markets are, a particular currency pair is rallying because they're pricing in 1 or 2 more interest rate hikes in the future. So that's driving the trend. So when the announcement occurs, then the market will respond accordingly to the announcement, but quite often the response is minimalized by the fact that it's already priced in. Okay? And you're familiar with that concept, a lot of you, because you're experienced with trading. Now, so that's what happens in these cases. So if there's a perception that, for example, in Japan, they're going to raise rates or hold rates, we could see some effect. But right now, the chasm is so large that the impact will be small, and that the carry trade is still largely tempting. When, if, and how this could collapse, who knows? Could happen tomorrow. For whatever reason that evolves, which the one thing that I love about the financial markets is that we all can have our little ideas as to when and why. We can all speculate on when and why. The one thing nobody knows is how. You can read scores and scores and scores of newsletters and information, but nobody knows how. And it's usually something that nobody ever could have thought of. And when it starts to fall, step 1, step 2, step 3, and these are all tracing the steps, nobody knows. Nobody knows. And that's what I love about this. Okay, so and I can talk a little bit about some of these, some of the different types of. I think this is very important information because I think this can be applied to each and every one of your portfolios to some degree. Okay, this carry trade can be done either through, through your bank. I think it's important to be positioned because of the global scenario that we are now engaged in. I think it's important that you be positioned globally, have a bank that works globally, and that's a whole other seminar. But have this type of opportunity available to you. There's other ways that you could do it if you want to do something like this through an FX platform. We have played with this, doing a carry trade through an FX platform, because as you know, you can experience rollover interest or pay interest at rollover. And for example, what we did with the pound yen as an example, because you all are interested in, how can I turn this into something that can be profitable to me, because that's why we're here. For example, this is the pound yen daily chart, and the slide that you saw went up to 240, but now we're up around 250. Okay, so for example, what we did was we placed very, very, very small position every day just before rollover. In this trend, just before rollover, we'd buy another small position, and then you get the rollover because it's leveraged. You get the old rollover of the leveraged amount at roll. Then I roll over the next day, right before roll, we'd place another order. On Wednesday it's triple Wednesday, okay, to account for the weekend. So we would continue to build the position size, then build the interest that you're receiving in the account, because the broker will pay where they owe you, and they will take away where they take away from you. And of course the broker pays less than they should and takes more than they should, because that's how brokers work. So and then after a while, then you want to hedge the position. Or what you could do is you could have one broker where you convince them to pay you rollover, and if you're a good client at another broker, you can actually convince them to not charge you the interest rollover if you're generating volume in other areas of the account, but hedge the one at the other broker, so you're receiving on one and you're not paying on the other, so you can accumulate on one, accumulate on the other, and you can have a hedge where you're receiving interest. So you basically are not exposed to the fluctuations, but you're just receiving interest. Okay? These are the quirky little things that we create to outsmart the marketing machines out there and the brokers to take advantage of just situations that they've presented to us. So that's just like a little idea, but I'm more inclined to do it on the cash basis. Is more stable for you. All right? Do you guys understand what I just said? Do you guys following me so far?
Yeah.
How are we doing?
Basically.
Okay, I'll try and. I'm sorry.
Just
What?
can you explain rollover?
Rollover. Okay, rollover is, let's say you have an account based in US dollars, and you're buying a pound yen pair. Right? So your position goes into the market, and it's a leveraged position, right? So the broker's only holding, maybe 1-2%, maybe 10%, depending on what your agreement with the broker is. They're only holding a certain percentage as margin. And then once, every day, the position has to roll over and to postpone settlement. Okay? And then it also has to postpone settlement on the position, but it has to settle the valuation of the currency pair that you're trading versus the host account. That makes sense? Okay.
But that's also when your account gets paid or pays out interest. Correct?
Yes. Yeah. So it will pay you each day.
Or
or take away,
Or take away.
depending. Like if you're short this pair, it's taking interest from you. Yeah. So that you have to acknowledge that when you're in that position. Okay. How we doing? Yeah. The carry trade. I know we've gone through it fairly quickly, but it's not difficult to understand. I'm perfectly happy to sit down and go over other aspects of it if you're interested throughout the course of the next few days. Oops, that's not a slide. Okay, the banks. What I want to do is I think it's important that you understand what goes on in the banks, what they do from a day-to-day basis, because we want to know what the traders that are making money or perceived to be making money, we want to know what they're doing on a day-to-day basis. Where is all this coming from? Where is all of this rooted? What's driving these transactions? What's driving market flow? What's driving price? What's driving volatility? How can I take advantage of it? Or how can I understand the volatility? What is the foundation behind the day-to-day activity in the FX market? So what I'm going to do is I'm going to walk you through sort of a bit of a daily routine for a bank trader, because in the bank you have there's two aspects that are flowing funds. Number one, there's a bank dealer. So a dealer is one who will sit at a desk and they'll have a list of clients. They may be corporate clients, individual clients, private banking clients. And what they will do is these clients will phone them, and they'll either take like speculative positions, or they may be positions for commercial transactions that are suitable or customized to their corporate situation. Let's say, for example, they build a widget in one country, they sell it in another, so they rely on that country for their income is in that country's currency, so maybe they're hedging it. Or, for example, maybe they sell their product, or they have to buy some component of a widget that they build from another country, so they need currency in order to buy tens of millions of dollars of a certain resource in order to help them to conduct their day-to-day business activity and build whatever it is that they're building. And so they have these clients, and what they do is some of these clients are speculating, and some of them are doing it for commercial purposes. And this is where the $1.88 trillion comes flowing through the market every day, because there are corporations throughout the entire world, individuals throughout the world that need to exchange money, hedge positions, and take also speculative positions. Microsoft Corporation, for example, they have their own FX department. And I've had some very interesting conversations with them in terms of how because they have positions, they have a total global position, and they have to be very, very careful and conscientious of their foreign exchange exposures, because it can change their books quite significantly if they overly expose or don't hedge properly, because they're buying from one country, selling to another, they're employing over here, and there's constantly assets and flow of funds moving just within that corporation. So they have a full department that is managing this situation. So you have the dealers, and you have the proprietary traders, and those are traders just like me and you who are trading, aiming to get profit. And believe me, they are just as much in the battlefield as you and I. They don't have any magic secrets over you or I, and some of these guys. The thing is the only difference between them and us is that the ones that don't make it get fired. So, because I was recently speaking to a dealer at Credit Suisse, and I was asking them, about some of their proprietary traders, and it was kind of interesting what they had to say. So, now the dealing. Pardon me?
What did they say?
It's being recorded. But we can talk later. So the dealing is reflected in the technicals, and of course we're going to have a look at some bank reports. just to give you an idea as to just sort of the undertones of the market. I personally think it's very, very important that we understand what's happening, because we all see what goes on in the banks. It's this mysterious activity where they have some enormous advantage over us. And what I want to do is I want to take you there, and this information is all available to you as well, and I can show you where it's available to you. Okay? I'm not sure if this slide is in your books, but there's some areas where you can go to Get Bank Reports, and I'll take you there later. But the market is all about, price is driven by market sentiment, whether it is synchronized or in confluence with the fundamentals, or price can go in the complete opposite direction of fundamentals. Interest rates are largely driving price action in the FX markets, and of course the investment climate, what's going on in the world, the geopolitical scenario, and the growth of various regions of the world, and some of the challenges that various regions of the world are having is largely a contributor to the undertone of the FX market.